G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm your host, Aaron Christie David, and I run a mortgage broking business called Atelier Wealth, where we help property investors build a quality property portfolio and also make confident decisions about building that portfolio. As an investor goes on their journey, I've often said there's a team that comes with them on the journey, maybe people that have been there before them, maybe people that can spot some blind spots and have their back as they go through. And yes, a mortgage broker is only a part of that journey, and this isn't about plugging myself at all. This is a platform that we bring on guests, and you often hear me what they call best in breed. So people that are top of their game, people that live and breathe property. It's in their veins a little bit. And today's guest is certainly a name that's been around in the industry for quite some time, someone that's been there and done that as well. And I'm really happy to have Zaki Ameer from DDP on the show. G'day, Zaki. How are you, mate?
I'm well, Aaron. Good to meet you.
You too, mate. You too. Look, we've got something slightly in common, which is probably our cultural roots, being that my parents hail from Sri Lanka and you came here as well. And I guess it's all part of your journey, which is, to come from Sri Lanka to come to this country. I often say to people, they're like, oh, property is expensive. I'm like, do you know how good this country is? Like, do you realize how blessed and lucky we are to call Australia home? And I guess you came to Australia when you were a young guy, 18. So it's definitely one, a cultural shock, but two, I guess the way that you've landed on your feet and built yourself financially and built a business in this country, again, you probably have that feeling of gratitude towards this country. For example, obviously what happens in Sri Lanka is very, I guess, disappointing to see what's going on in the country itself. But again, it's just that reminder to go, hey man, lucky sperm club, we are grateful to call Australia home, right?
That is for sure. Australia is home. It's been, I think, 21, 22 years. And looking back at what's happening in Sri Lanka right now, I think people like yourself, myself, and definitely Macquarie CEO and the hedge fund guy in the States, I think there are a lot of Sri Lankans that have done really well in business and leading companies. And I feel like we should probably go back and lead that country if we're allowed to get it out of the mess.
Yeah, that's a whole different kettle of fish, mate. But it's, I think what happens is, and we see this with a lot of migrants that come to this country, there's a hunger in the belly, there's a feeling of what they left behind to start a new life here as well. And what I say about investing and buying property, it creates intergenerational wealth, literally within one generation. Like one good decision by someone coming to this country can change an entire trajectory of that family wealth position within one generation. Like that just blows my mind that you can generally move, say, from middle class to upper class by making one good quality decision, which is buying property. Yeah. And I really want to go through this with you and talk about your journey, because I feel like a lot of people will have a similar-ish journey, which is I'm coming to this country, or I'm a newish investor, for example. How do I make good decisions that help me either scale up my portfolio and live a life effectively on your own terms as well, which I think becomes really, really important. But take us through, and I guess it's what I call the 3 Ps, a little bit about yourself personally, a little bit about yourself professionally, and a little bit about your own property journey in a nutshell, Zaki.
Well, I guess myself personally, my parents have been in business, my grandparents have been in business. I think there are cultural roots or DNA roots, be it genetic. However, I think just because your family is in business doesn't mean you would succeed in business or get into business. But it did play a part in terms of taking a risk. And I think that's what they kind of did with myself. They said, you're 18 years old. We put you into a good school back in Sri Lanka. We'll ship you out to another country called Australia. And in fact, when I was choosing universities or TAFE, because we were international students, and today this applies, it's foreign exchange. Every uni I applied to, I got in, even though I don't think I was very intelligent or academic to pass any of those universities, be it Sydney or Macquarie, etc. And I actually chose Mount Druitt TAFE initially because I thought it was on a beautiful mountain. And that was my first picks, because that's how clueless I was about where you're going. And I think it is a deep shock. And my take, I feel like, is that if I can make it without any family, no cultural backing, etc., coming at a child age, well, when you're really young is a good thing. But I feel when you come here, when you're 17, 18, you're already built up, on how you're going to operate in society, that makes it even more challenging. And I feel if I could make it and navigate through Australia, anyone who follows the principles I went through, I think will make it for sure.
Yeah, nice. Really good sentiment. And look, when I've reflected on your own journey and buying your first property to then buying 10, for example, and building a portfolio at the start, and don't take this the wrong way, but was it beginner's luck, for example? Was there a conscious decision behind it? Was it just something you get into the market? Can you kind of rewind the clock a little bit?
I feel when I define luck, I think luck is continuously taking chances. And the more chances you take, one of those chances is that lucky one. It's kind of like if you want to win the lottery, maybe your chances are low, but you may win it, but you got to enter the contest and buy the ticket. So I feel the more tickets you buy, one of those tickets is lucky. So yes, there is luck, but it is also part of, continuously taking risks. And I was introduced to property simply because I was looking for a way to get ahead from a migrant point of view, because there's nobody else around me giving advice from friends or family, because friends and family really didn't exist because you're in a new country. Yeah. And I just put myself out there. Everything was, I guess, a paid meeting in the sense I was paying for advice, which I think is a good thing, because when you're paying for advice, you hope that you're getting advice from people that have done it before, rather than what I think most people that are, first, second, third, etc. generation, you tend to take advice from people in your inner circle that have probably not, done what you wanted to do in life.
Yeah, no, definitely. That's a common thread, which is family and friends have your back. They've got you. They love you. They want to see you make good decisions, but quite often the advice that they're giving is from a place of almost protection rather than acceleration sometimes as well.
Yeah.
Yeah, perfect. Reflecting on your own portfolio, are there things that you go, hey, look, this worked really well, I would replicate that or copy that decision, and the things that maybe didn't work well and you probably learnt from, I guess, maybe not setbacks, but failing forward as well?
I feel, well, when I did buy those properties, the 10, and then I continued buying, and they were all back then based in Western Sydney, Southwestern, averaging $250,000, which you wouldn't even hear of these days in Sydney. That is the power of property. And I saw a post of a 1970 property price in Epping and Eastwood for $70,000, which is now valued at $2 million. And you could keep saying that. And the mistakes, I guess, and then I ended up writing a book based on that journey, and I ended up writing a chapter because the book was based on my experience to that date. And I wrote a chapter on why you should not buy brand new properties and why you should not buy off the plan properties. And 15 years later, I look back, and when I speak to clients and guide them through, I say, there is a positive or a negative or a pro and con with every type of property. It just depends where you are in the property journey and how it fits into your profile of risk, or what to take and not to take. So I don't think you can just outright say, this is not good or that is not good, and make a general statement about property. I feel I missed opportunities by not buying into certain off-the-plan projects. I definitely missed opportunities when I actually wrote and were guiding on not buying regional property. We've seen the last 2 years, regional property has been extremely hot. And I actually had properties in Wagga, and honestly, I was given the same advice. I said, when I get a property from my client, I said, things will happen in life. As long as we can have a tenant, keep going and don't sell the property until it at least has doubled in value. And I didn't take that advice for myself. When it came to regional property, I had 2 properties in Wagga that I actually bought for $100,000 with just a $10,000 deposit. And 5 years later, I sold it because I had problems with the tenant. So I didn't take that advice, and it was regional. And now that property is worth $300,000. And we don't look at the 200,000, I guess, appreciation. What we look at the ROI, the return on investment, is far greater than some of the properties in Sydney. So property, even in regional areas, does work as long as you can find a tenant and manage that process. It all comes back to where that client is and their risk profile.
Yeah, well said. And again, that's a common, when we're speaking to buyers agents, the first thing we generally, people, the banky word or the formal word for it is risk profile. I call it the sleep at night factor. So what's your sleep at night factor? How much debt level can you sleep with compared to myself? Yeah. How many properties will let you sleep at night versus keep you awake? For example, if you're in a partnership couple, one partner has a certain profile or sleep at night factor compared to the others. For example, it's finding a happy medium that you both can agree that we know that we both want to buy, but where do we find that sweet spot as well? You mentioned something there that I want to talk to you about specifically, because buying new versus buying established versus buying off the plan, there are three different types of buying an investment property. So typically buying established, people can see it, they can get it into it now, for example. Maybe it needs some work, maybe it's in a great area, for example, so they got that. Buying off the plan, you're buying today, going to complete in the future as well, versus buying something new that's completed. So you said there you initially had reservations about buying off the plan. What changed for you? Now what do you do when you're consulting clients, for example? Take us through that journey, mate, in terms of asset selection.
Okay, so I guess when I speak to a client, I think it's giving them all the options that you can go existing, and these are the examples. You can go brand new, these are the examples, and you can go off the plan, and these are the examples. What are the advantages and disadvantages for both, and assessing how comfortable they are with either or option. Now, we're in the Perth market right now. We buy Australia-wide in major cities, and we've been in the Perth market probably for the last year and a half, because as you've seen in the last 2 years, Queensland especially has gone up 30% in year-on-year growth for the last 2 years, when national growth is about 6.5% in the long run. So when I see 30% figures in 2 years every year for the last 2 years, and 6.5% nationally for the last 50 years, there's going to be an adjustment. That adjustment might be flat, that adjustment might be downwards, but clients might be sitting around. And they will, just like my properties in Wagga, eventually make money in 10 years, like history has shown in the 10-year cycle for the last 70 years. But the reason we're in Perth and why I might go towards the brand new property route is because Perth on its own and its surrounding areas is very new. It's not like Sydney. Even when I was buying in Western Sydney, even though back then it had stigmas, it was still an old city. Blacktown was an old city, Mount Druitt was an old city, Liverpool, etc. However, the areas in Perth, the properties that are brand new and the properties that are existing are very similar price. Okay. There's not much bit of a price difference. Yeah. So the saving then is that you save stamp duty, because you only pay stamp duty on the land as opposed to the full purchase price. Yeah. Yes, there is the depreciation benefit. That really should only apply if there is substantial benefit, if you're a high income earner, as you know, to get a taxable income. If you're a low income earner and a few extra rand, if you're not even going to get a refund, that's, different companies push different things. It doesn't really apply to you. It needs to make sense. Does that apply to you? The builder's warranty, but at the same time, are the builders going bust? So there's a pro and con to that you've got to, hold the land for 6 months while it builds. Or do I go and buy a property in Brisbane and the builder goes bankrupt, like what's happening right now? So I think it's what we're selecting. Is it the purchase price? Is it very similar, like we're finding in Perth, between an existing property and brand new? Are the builders trustworthy? Are they been around? We don't work for builders, we work for clients. Yes, we can get paid by builders, we disclose that. However, we still select builders and review other building projects that they're currently doing, as opposed to that they've been in the market for the last 100 years, and yet they can still go under. So it comes back to that selection and then letting the client know which is your pick. Some clients make a call to us and say, I want a brand new property outright. Because they've just been conditioned, but they actually haven't thought it through. Is it correct? Because I might find them a property in Brisbane, where there's issues now in the brand new section and the house and land section, where we could get a property that's just been completed 6 months old, maybe for a little bit cheaper. And maybe that's what you do, pay the stamp duty and not have to deal with builders. That might be suitable. When it comes to off the plan, I think I'm referring more to apartments, off the plan. And I think there's a segment of the population for that, because some say, apartments are bad, which can't be true. I've only really lived in apartments since I've lived in Sydney, and they've doubled in value. And I think if you're buying anything within 5 kilometre radius of Sydney, it's probably an apartment, and it does work. Bondi apartments aren't going down. So there is appreciation in apartments.
Yeah.
However, if you're buying an apartment off the plan in an area 200 kilometers out when there's a lot of land to build a house, well, maybe you should buy a house. Why would you go buy an apartment? So off the plan, as in, are you going to sign a contract? I think that comes down to, are you signing a contract at the peak of the market, or are you signing a contract when the market's at a low? If you're signing off the plan contract like last year and the building is going to complete in 3 years, which is say next year, in 2 years, when we don't know where interest rate rises are going to be, we don't know what valuations are going to be, we don't know what APRA is going to do with lending restrictions, well, that's probably not the best time to be buying off the plan.
And look, from an experience share, when you buy off the plan and you're due to settle, you don't know what your situation is going to be at that stage. You've seen multiple times people have changed jobs, for example, taken contracts, had a child, maybe even a second, and all that can impact serviceability. So when we're talking off the plan with a delayed completion and then to settle later, you have to almost forward plan for some type of scenarios or have backup plans as well.
Correct.
Valuation risk could be another one, which I think you just alluded to there as well.
Yeah, I think as long as we, advise the clients, guide the clients, and these are your risks, these are the ups and the downs, and they go, yep, I'm aware of it, I'm happy to go with A, B, or C option. I think every type of strategy should be put forward, and make the client choose what's best with guiding them. Yeah,
well said. As you've built your portfolio, there are definite shifts. One would be, say, borrowing capacity, serviceability assessments, for example, like the way that you were able to lend and leverage 10 years ago versus the way that you're able to lend and leverage today, very different. Yeah. Right. So there's been a definite pendulum swing. I guess capital growth was great, pull the equity out, bang, for example, here we go again. Whereas now cash flow seems to have that, that layer of importance, which is, lenders then take shadings on rental incomes, adding, extra expenses, for example, which then pushes that whole notion of cash flow when you're trying to then scale at as a portfolio investor as well. So on your journey, when you talk about it, again, leaning on some of the client interactions you're having, do you have a particular skew towards maybe cash flow or capital growth? Again, it's maybe strategy and brief dependent, but from your own outlook, what does the importance of one or the other look like? I
think what their income earning capacity is part of it, because if their combined income is like $500,000, they're in the IT section, husband, wife, both are in IT, have a lot of clients like that, they're paying a lot of tax, no investment properties. Yeah. I think negative gearing has a part in it, but it should not be the solution to buying property. Because because negative, it's a side benefit. Negative gearing means you're making a loss, and that needs to be made clear. It might be a loss to depreciation, but you also have to see if you're making a cash flow loss, and can you sustain that cash flow loss? I feel it has I do feel that usually some negatively geared properties tend to have higher capital growth, and high cash flow properties tend to have low capital growth, because we deal with dual income, granny flats, NDIS, NRES types of properties also, which are high income, and where clients just call directly because they've seen an ad from some other company going, oh, I want to buy this dual income property. Yeah. But I go, did you know that you're going to spend an extra $100,000 to purchase that dual income property in build or purchase costs, plus stamp duty, plus your debt amount, to get this few extra $100 in rent? Whereas maybe you may consider just buying a single income house for less stamp duty, less debt, and get a little bit less rent, because maybe that extra rent is not what you need right now in life, because it's not going to help you retire. Correct. But maybe somebody in their age, 50, 55, depends where they are, and they're heading towards retirement. And this happens for our self-managed super fund clients, where they're thinking of cash flow, because they're going to stop working. That's where maybe income-based strategies are important, as long as the tenants can be secured and it is proven that is the income they're going to get. So I think if you're a high income earner and you're in your mid-30s and you're earning $500,000 and you're going to be working for another 30 years and you're at your peak of your life and your career, why would you want to pay more tax? Why would you want more high income properties? But at the same time, it doesn't mean you just keep going negatively geared, because you might be a high profile job, in a corporate position, but you may even lose your job in a downturn. And then what are you going to do with the negatively geared properties? Because you're at a cash flow loss, and then you've got to have backups for that. So
It definitely is
Yeah.
definitely is a strategy when we're talking to higher income. And again, you're right, higher income versus, capped earnings, for example, where you may be in a role that you can't have that high level income growth. It's an inverse effect. Like, you want the positive cash flow, but now you're going to pay more tax. Like, you're making money, and that's a wonderful thing when you're cash flow positive. The outcome of that is now you're paying more tax when you're paying a large amount of tax. And we should be talking about tax effectiveness, for example, as well. And this almost then brings in the conversation when we're talking about tax into your accountant, for example. And then how do you acquire these properties? Are you buying through a trust? Are you buying through a company, for example, SMSF? What's the exit strategy when we're talking? So again, where I'm getting to this, if you're listening to this, is people focus very heavily on the asset. What am I going to buy, the property? And lesser consideration is given to, okay, so what entity are we going to buy this, for example? Do we have a game plan around exiting this property? Is it the buy and hold strategy? Is it the buy and sell strategy? What are we talking? And are you having those conversations with clients and seeing that firsthand, Zaki? Or what's your...
I think every client comes with a view, because that's where they are, based on advice they've taken, friends they've spoken to, saying this is what I want. I think our role, as much as I can be a buyer's agent and just find them a property and go, here's a great property, I feel the right thing to do, I think ethically, because I know things based on experience, to let them know there are other options rather than here's a great property. Is to let you know. And I think that's just based on experience and buying different types of property Australia-wide, just to let them know, hey, have you thought of this? Have you thought of that? Have you thought of this? And then let them make a call.
Yeah, cool. Thanks very much. One of the other things when we've had a chat in the past was, I guess, what you're buying and where you're buying. You mentioned you're buying Perth, for example, which is quite similar to buyer's agents, because again, price point and yields, for example, are a great marker. And you mentioned, look, I help clients probably around that sub 650, for example. That price point, take me through it. Is that a deliberate strategy? Is that opportunities for growth? Take me through that type of number.
I think regardless of your income potential, let's say up to maybe $400,000 combined income, right? And usually you have a family, children, so there's expenses involved, so there's gross income, and then what's there at the end of the day. I feel by capping it, the mortgage or the debt level you're holding is less, and the rental yield is usually higher. My take on that is, higher the purchase price in a capital city, the less rental yield you're getting. The less rental yield you're getting, the more negative cash flow you're going to need, the more you're going to have backup funds to keep putting money every month onto expenses related to that property. So I feel when you limit it in Perth, the brand new properties or even the existing properties are probably averaging 450,000. And we're finding properties, I'd say 350,000 upwards, which reminds me of Mount Druitt and Penrith and Liverpool when I got in 15 years back. And then we went into the Brisbane market about 5 years back on that similar point. And that's where we're seeing, potential in Perth before, I guess, majority of the population and the media starts pushing people into a certain area. I feel prices have already gone up. So I kind of want to get my clients in with a low purchase price, big land, high rent with room for growth.
Okay.
And diversify the portfolio with less debt, less deposit, and keep repeating it.
Yeah, okay. Yeah, I guess it's what we'll go back to what I said before, sleep at night factor, for example. And I guess the crossroads for some investors is, do I buy two at say 400 or do I buy one at 800? Again, maybe it's strategy dependent. Maybe it's, the questions you need to ask is around yield and debt levels as well. But I feel like that's probably a question that comes up quite regularly for yourself as well. Do I buy two at 400 or one at 800? I
feel even for myself, when I started 15 years ago, I knew nothing about property. I was still learning, and I was given from a property developer an off-the-plan property in Balmain, a one better. I feel it was 500, 550, which I'm sure is very cheap in today's market in Balmain. Had I just bought that, well, obviously I would have made money and capital growth. Instead, I split it and went and bought a few properties in Mount Druitt and Liverpool, and I had a diversified rent. But when I look at it put together, the fact that I was able to diversify, then I've got a combined capital growth far greater in purchase price than that one apartment of the plan in Balmain. And I think when I compared those situations, say if you had 6.5% growth in Balmain and same or more growth in Western Sydney, Southwestern Sydney, because the capital base was larger, I could comment and say, well, I probably made more in my Western, Southwestern Sydney because I was able to borrow more because the rental yields were higher than just buying one property.
Yeah.
But at the same time, you've got to be okay with that. You've got to be okay with managing tenants and all the dramas that come with that. And different banks, different lenders. It's not easy. It may suit for you to just go buy one property, and that's okay. I tell my clients, I never say you should go buy 5 or 10 or do what I did. Some clients, earn $1 million and are happy to buy one house.
Yeah.
Some, myself, didn't earn much and wanted to buy a lot.
Yeah.
It's whatever suits the client. Go step by step and see where they're at.
Yeah, well said. Perfect. What's the future hold for DDP, mate? It's what's the next iteration?
I feel like we just want to be ahead. Many said real estate agents or anyone in the property industry is going to find it challenging. In the last few months, I didn't really see it as a challenge. I think being in business, I felt like we've just got to be ahead of the market and come up with new opportunities. Where clients need our help and guidance, and that's what we do. We're just going to keep finding markets, whether it be in Australia, given even Sri Lanka. My family's in different countries. I feel my dad's take on this: if you'll do always well in property because it's God's land and it's earth. So I feel like I think if you speak to anyone's. Even I own some land in Rwanda. I feel like when I went on a charity trip, I know that land was 10,000 and it's tripled in value. And this is in Rwanda, And, my take is if you follow the fundamentals, buy well, make sure you can afford it, or make sure you have rent, hold for the long term, you'll do okay.
Yeah, nice. Hey, thank you very much. Yeah, mate, really appreciate it. What we'll do is we'll include details for Zaki Ameer and his team at DDP. If you want, like we said, do your due diligence when you're looking to bring on your team, people that have either been there, done that, or maybe have a particular niche that will serve you, and if you feel like that's the connection that you want, we'll include details to their website and their socials to check out. And mate, wishing you all the very best for your journey as well, mate. Thanks for being on the show.
Thanks, Aaron. Thank you.
Perfect. That's a wrap for another episode of the Australian Property Investment Podcast. If you've found that helpful or you have some questions, please reach out. We'd love to hear your comments and questions as well. And until next time, take care.